الإخوة والأخوات ضيوفنا الكرام، الآن أتشرف بدعوة الأستاذ ديميتار ميكيف المدير المساعد في بنك NIBC لإلقاء محاضرة بعنوان تعلم الآلة وإنترنت الأشياء كمغيرين لقواعد إدارة الائتمان. نرحب سويا بالأستاذ ميكيف. طبعا المحاضرة باللغة الإنجليزية، فلمن يحتاج الترجمة فأجهزة الترجمة متوفرة في القاعة.
Thank you all for coming here today. I'm really excited to be part of the biggest IoT conference in the region. It's also my first time in Saudi Arabia, and I'm really thankful to the organizer for this great opportunity. My name is Dimitar Mechev. I'm head of modeling and data analytics department of NIBC Bank in the Netherlands. And today I'm going to talk about how IoT and machine learning are changing the game in credit risk management and why this is so important for all small and medium enterprises around the globe. I will start with presenting you the challenge which all small and medium enterprises are facing, and this is that they're being underfinanced. We'll talk about how traditional banks are losing their market share and how new and innovative companies and financing providers are using new technologies and new data sources are providing financing for SMEs. We'll compare the traditional data sources with the innovative data sources. We'll see how IoT plays a role there. And finally, I'll show you two IoT and machine learning-based solutions which are really helping SMEs to receive more adequate and cheaper financing. SME stands for small and medium enterprise. It is defined as all companies with lower than $50 million balance sheet. And those companies are facing one same problem everywhere in every single economy. They're underfinanced. While bigger companies receive adequate financing, more than 50% of them receive formal credit from a financial institution, the picture is not the same for medium and small enterprises. Only around 20% of them receive formal credit from a bank. And when we zoom into the numbers in this region, it is even lower. Only 1.7% of all lending in Saudi Arabia is targeted to small and medium businesses. I'm not going to talk about the specific issues in the current market. I would rather focus on the main three challenges and reasons why SMEs has a financing problem. First is the insufficient knowledge and awareness on the business owner side. Business owners are often not aware of what type of alternative financing there are and how to get those. Very often the process of getting the finance is very cumbersome and requires expertise which small businesses don't have. Second is the high perceived risk on the lender side due to lack of data, verifiable and reliable data sources. Lack of data and high perceived risk inevitably translates to higher borrowing costs. And last but not the least, post-crisis banks are facing more stringent regulations. They're required to hold more capital for high-risk assets, which again led to complete avoidance of financing SMEs, or when they do, it is very expensive. After the crisis, you can see a consistent trend. On the right side, the red line, banks are losing their market share. This is mainly due to regulation, and at the same time, other financial intermediaries are increasing their market share consistently. Part of these intermediaries are the so-called fintech companies, or the financial technology companies. Those are companies who are using new technologies, new data sources, and are challenging the way banks are doing financing. They're reinventing the lending process. And in order to see how they do that, first we need to see how an old-school lending process looks like. And this is still the case for many developed countries and big banks. The lending process starts with filling forms, documents, scanning, signing those, sending them over the post or email. and somebody on the other side has to manually check the validity if everything is filled in properly. This very often takes few iterations. And only then the bank can calculate actually the risk on this client and approve or disapprove the credit. This whole process can take few weeks. And it's not the end, because during the lifetime of the credit, the bank needs to recalculate the risk on the client, and this process can be reinitiated several times. The problem is that it's a very inefficient process. It leads to high operational costs for the financing providers, which translates to higher borrowing costs for the small companies. Second, it's very slow and complicated, and some of the companies are lacking the expertise to go through this process. And most importantly, it doesn't provide the transparency in the risks that the financing providers are requiring. Let's see what type of data banks are using within this traditional lending process. Those are the financial statements, the balance sheet, the income statement, cash flow statements. Extremely structured and valuable information about the business. It is also very much reliable. However, it is not always available for small businesses. Small businesses are not issuing annual reports. The financial statements are often of a lower quality. It is also issued at max once a year. And it is not, the moment the bank actually uses the data, it is often outdated, up to a year before. So how the new companies, how the fintechs are changing the game? Very often the fintechs are allowing business owners to apply for a loan only by their cell phone, scanning their ID or passport, scanning the ID of the company, scanning the current account of the company, and almost real time, the fintech is able to tap into third-party providers of data and information, and real time calculate the risk on this client. The approval of the loan often takes up to a few hours, and the money are wired in a couple of days. The process is much faster and simpler. Of course, it is cheaper, which means lower borrowing costs for the small companies. And very important, it provides real-time risk management, real-time risk information, which allows the financing providers to provide cheaper and leaner service. The data they're using are three types of alternative data sources. First, very important, the transactional data. Those are the cash flow data, which is the raw financial data behind every economical business activity. The cash flow data is extremely valuable because it contains information not only about the business activity, but about also the customers, the size of the orders, and so on. Second important data is the sensor data. The more connected is the business, the more data they have for their business activity. Those are the sensors in the movable assets, like trucks or machines, or sensor data from the production facilities, sensor data from the warehouses. This is extremely valuable data for the lender as well, because they can real-time calculate what is the risk on this client, and which will allow them to provide cheaper financing. And last but not the least is social media. While sensor data is very much relevant for B2B companies, social media data is relevant for B2C companies or business to consumer. Likes in Facebook or other social media provides information about the customers of the small company, how they perceive the new product, which is effectively a proxy for the capacity of the company to repay its loan. If the product is selling well, the bank perceives this as a low-risk company. So this data, in comparison to the financial statement data, is high volume, high frequency data, provides a lot of information. It is low-lagged, it's almost real-time, especially in terms of sensor data. It is trustworthy, it is effectively coming directly from the sensor to the database and analytical tools. With one caveat, it's less structured. While we have very well-structured financial statements, here we were talking about streams of data. And in order to work with this less structured data, we need a bit more sophisticated tools. So when we are talking about risk assessment or assessing if a client is good or not, we are effectively solving a classification problem in machine learning. The simplest problem is when we have two classes, good or bad client, or approve or disapprove the loan. We can have more classes like low risk, medium risk, high risk, or how banks are doing it, up to 21 classes, which are actually the credit rating of the company, AAA, BBB, and so on. So in order to solve this classification problem, we need to find the decision function, which takes, on the left side, you can see the x1 to xn. Those are the features or the information for the company. And we calculate the decision, which can be yes or no, to approve the credit or not. The features can be variety of data, like balance to total cash outflow in the last several days. This is more coming from the cash flow information. Current expense to X-week moving average expense. Some earnings indicators. Days in inventory, which is data coming from the sensors, for example. And finally, we can calculate the risk score or ultimately the decision if we should allow the credit or not. What type of tools do we need to solve this problem? Well, traditionally, banks using the financial statements, they are using the so-called logistic regression, maybe one of the simplest tools for solving this problem. It is very straightforward, and it works well. Unfortunately, when we want to use alternative data sources and when we have to use those because others are not available, we need more sophisticated tools like neural networks, decision tree ensembles. You have heard about the XGBoost algorithms, random forests, and so on. This is the case because we want to work with less structured data. And with less structured data, those more sophisticated algorithms are performing better. They're more flexible to work with these innovative data sources. And unfortunately, they have one problem. They lack explainability. So we are less able to explain why the algorithm takes certain decision. And we can be also fine with that. I'm not saying that we should be able to explain. It's a philosophical question. If we should care how the machine is making a decision, if we're happy with the decision, maybe we should not care. It is also a business question because letting the machine deciding for us means that we are also losing the ability to gain knowledge from the machine or to become better experts. If we just let the machines decide for us, then in many cases we are losing our expertise in the long term. And last but not the least, it is a regulatory question. In many applications, like in consumer lending, it is not allowed to have complete black box algorithm, which you don't know why it takes certain decision. This is the case because in many environments, I think in Europe, in the US as well, the banks are required to provide information to the borrower why a credit was rejected, for example. And in this case, you need more explainable algorithm. So it's always a trade-off between the performance and flexibility and explainability. And again, it is really up to the concrete business application in order to find the right trade-off. Next is, I want to share two extremely important considerations which are often neglected when we're talking about machine learning. Machine learning is often thought about this magical tool where you just throw in data and you receive value out of it. And actually, before that, there is one extremely important step, and this is the data pre-processing, or cleaning the data. Getting to a clean and reliable data set requires most of the time more than 50% of the time and effort when you're solving a machine learning problem. And you have heard about the quote, garbage in, garbage out. It is extremely relevant for machine learning applications. Next to that, once we have a clean data set, we should think about the so-called feature engineering. And feature engineering is effectively getting the X1s or these features, defining them. In many cases, like with financial statements, they're already defined for us. Those are ratios, financial ratios, which are used from all over the world, from all banks, and we don't really need to engineer anything there. Unfortunately, when we have more raw data, then we need to think, okay, how we are going to engineer these features? What are the concrete data elements which we need to take into account to, in order to solve the decision problem? And of course, we can approach it and fully automate that. We can ask an algorithm to generate the features for us, which will lead inevitably to a black box model, and we will lose explainability, which is, again, the trade-off between explainability and being fully automated. And this leads to the first use case I would like to share with you. This is the so-called working capital financing. In case of industry, let's say production company, would like to produce the next batch or would like to honor the next order, they need a short-term financing. For that, the banks are using the work-in-progress goods, inventory, or finished goods as collateral in order to allow this financing. And the whole process of monitoring the inventory levels to calculate the risk for this short-term financing is extremely expensive. It takes a lot of man-hours from credit risk officers and loan officers. And now with IoT, with real-time information from sensors, we can calculate inventory levels, we can calculate sales and costs almost real-time, which allows banks to provide cheaper financing by calculating the risk on those companies real-time. So with higher risk transparency and with IoT solutions, these companies are able to receive cheaper financing. Another thing is the message here is that the more you're connected, the more your business is connected, the more your data you gather, the easier it is to prove to the financing party that you're low risk and you'll be able to get cheaper financing. The second use case is from equipment financing. This is a company I was advising a few months ago in Rotterdam. They're financing heavy machinery in the construction business. So if you want to buy the next machine you need for the next project, you go to them, they install a sensor in the machine, if it is an old one, or the new ones are already coming with fully equipped with sensors. And they monitor the business activity of the machine throughout the lifetime of the loan. They get data on location, on impact, temperature, vibrations. And in that sense, with this data, they calculate, for example, if the machine is moving, if the machine is actually creating value. They calculate if the machine is used properly and how fast the value of the machine is amortizing. So at any point in time, they know if the company is actually creating value and what is the amortization of the machine. So at any point in time, they know the value of their collateral. With this real-time information on the business activity and the asset values, They can calculate very well the probability of default of the counterparty, but also how much they can recover in case of default. And again, this allows them, this transparency allows them to provide cheaper financing and to be extremely competitive on the market in comparison to more traditional lenders like the banks. So with that, I would like to conclude, and hopefully I gave you a few examples how IoT and machine learning are really changing the game in financing and how this is so important for the small and medium enterprises. I'm happy also to answer any questions, either now or you can send it to my email. I'm happy to share any data and knowledge I have. Thank you. No questions, I guess. Oh.
Yes, thank you, Mr. Dimitar, for this presentation. Actually, I just read in the newspaper yesterday that there is 11 companies related to the fintech in Saudi Arabia will be licensed here. So from your experience, as you presented here.
Sorry, I cannot hear very well.
Yeah, okay. I'm saying here we are in the process in Saudi Arabia. I just read in the newspaper yesterday that the central bank, which is called SAMA here, that they are in the process to license 11 fintech companies. So related to your bank and your experience, so you said the fintech as a new process for giving the credit instead of the traditional way for the SMEs mainly, and also the startup. The startup is very risky also. You mentioned the third party that will do all the process for the bank, and that the third party having the data. So my question about the data. We know the value of data depends on the veracity of the data, which means the accuracy. So how can you be sure about that the third party has the data in his storage can be reliable? Thank you.
Okay, so the question is how we can trust these third-party data providers, which we rely on to calculate the risk. In many cases, those third-party providers is actually the government. Those are databases which are either maintained by the government or databases maintained by several parties. And in many cases, you cannot trust them. So in many cases, you just have to rely on the data you have. But this is very often this is the best you have anyway, because this is the only available data on these small companies. So it is always a question how much you can trust the data. And yeah, there always have to be an assessment if the data is reliable enough. But very often that's the best you have.
Yeah, I have a question regarding how do you perform the monitoring of these assets? Do you have a central monitoring system? And if you have different type of machinery, how do you, what is the strategy to actually monitor these different assets?
How it works is that such a financing provider work with third-party providers of these GPS or sensor devices. They're either already built in the new machine or it is attached to an old machine, and there is a kind of API portal where you can tap in, and by the ID of the machine you get the data which this third party is already providing for you. In that sense, the lending provider is not the one really installing the sensors, but they're relying on third-party services to do that for them.
Thank you for your nice presentation. And my question to you, you mentioned in the presentation that you have depend on the tool for feature generation. And if it is dependent on the tool, it will be black box in modeling. How you overcome this problem in feature generation?
There are many ways to achieve explainability. You either opt for, let's say, for more explainable model in its nature. If you want to go for the fully complex model, let's say a neural network or ensemble of decision trees, then you, how it is done in practice is that you create another simpler model for a very small portion of the let's say the decision function. So you interpolate the decision function with something very simple in order to explain the decision in a local way. So the original decision function is something very complex and nonlinear. However, you can focus on small part of it and explain it with, let's say, a logistic regression, for example. And this gives some comfort on why certain decision was taken. But effectively, it cannot be this doesn't really help you to be fully explainable, but still to have some insights what are the main factors driving the decision.
Thank you very much. This will be our last
Thank you.
question. Thank you very much. Thank you. And in thanking you for such a wonderful presentation, we'd like to honor our guest. شكرا للأستاذ ميكيف